Monster Beverage Corporation, the world's leading energy drink company. Monster Energy, sold in over 150 countries through Coca-Cola's global distribution network.
MNST generated $7.4 billion in FY 2025 revenue at 54% gross margin. Capital light, co-packer manufactured and distributed through Coca-Cola's bottler network worldwide.
The story begins in 1935. Hansen Natural Corporation, founded in California as a juice and soda company. In 2002, Monster Energy launched and became the defining brand in the convenience store energy category.
In 2012, the company rebranded as Monster Beverage Corporation and divested its juice brands. 3 years later, Coca-Cola took a 17% equity stake and became Monster's primary global distributor.
In 2023, a co-CEO structure was formalized with Rodney Sachs and Hilton Schlossberg. By 2025, Monster launched an alcohol beverage segment, the Beast Unleashed hard seltzers and Nasty Beast hard tea.
Monster energy drinks generate 93% of revenue, sold across convenience stores, grocery chains, and club warehouses globally. The remaining 7% comes from strategic brands and the new alcohol segment.
The Coca-Cola distribution deal is Monster's structural advantage. Coke's bottler network covers virtually every retail outlet on Earth, giving Monster global shelf access without owning manufacturing or logistics.
Gross margins held at 54% in FY 2025. Operating margin runs near 26%, reflecting the capital light model where Monster owns the brand and formula while outsourcing production.
Revenue grew 5% to $7.4 billion in FY 2025, a deceleration driven by U.S. market maturation and Celsius competition. International markets are the primary growth engine going forward.
Celsius Holdings is the fastest-growing energy brand in the U.S., targeting fitness-oriented consumers with a healthier positioning. Monster's convenience store dominance and global scale are the primary defense.
Red Bull is the global category co-leader, stronger in premium on-premise and travel retail. Monster leads in convenience and grocery volume, holding over 30% U.S. energy category share.
Monster's moat is the Coca-Cola partnership, exclusive distribution rights through the most extensive beverage network on Earth, combined with a brand with decades of youth and action sports identity.
Monster Energy is sold in over 150 countries through Coca-Cola's bottler network. North America generates the majority of revenue, with Europe and Asia Pacific as the growth frontiers.
Europe is Monster's fastest-growing major region, strong in the United Kingdom, Germany, and the Nordics. Asia Pacific and Latin America remain underpenetrated relative to per capita energy drink consumption.
Hilton Schlossberg has served as co-chief executive officer since 2023, alongside Rodney Sachs. Both have been central to Monster's transformation from a regional juice company to the global energy category leader.
Schlossberg joined Monster in 1990 and built the Coca-Cola distribution deal, replacing fragmented distributors with Coke's global bottler network and transforming Monster's competitive position worldwide.
Monster Beverage, the global energy drink leader, $7.4 billion in FY 2025 revenue at 54% gross margin, with international expansion and alcohol beverages as the next growth layers.
Q1 2026 delivered a beat, $2.1 billion in revenue and EPS of 58 cents, ahead of estimates. The full episode covers international penetration rates, alcohol segment traction, and the Celsius threat.
Monster Beverage just put up one of the cleanest double beats in consumer staples this quarter. Revenue up 27%, EPS up 29%, operating margin of 31% on a beverage company. I am Hudson, and this is Charged Alpha.
And I am Lana. Monster Beverage, ticker MNST, beat both revenue and EPS estimates today. International markets are the structural growth engine. The stock is near its 52-week low despite accelerating fundamentals.
Monster Beverage was founded in 1935, then pivoted to energy drinks in the early 2000s. Today, it is the number 2 energy drink brand globally, with over 40 SKUs across Monster Energy, Reign, and Bang. The Coca-Cola distribution partnership, Coke holds equity and moves Monster through 200 countries, is the structural moat.
The company has 5,900 employees in Corona, California, Market cap is $73.8 billion at $75.97 per share. Q1 revenue was $2.35 billion, up 26.9% year over year. Net cash is $2 billion. Return on equity, 34.5%.
What separates Monster is the asset-light model. Coca-Cola's bottler network handles distribution, so Monster does not own trucks or warehouses. Capital flows to brand building instead. Asia-Pacific and Africa remain early in energy drink penetration. That is where the next growth decade comes from.
Q1 2026 revenue was $2,353.3 million against the street estimate of $2,160 million, a beat of $193 million, or 8.9% above consensus. Year-over-year growth was 26.9% from Q1 2025's $1,854.6 million.
EPS came in at 58 cents. The street estimated 53 cents. That is a 9.4% beat. Q1 2025 EPS was 45 cents, so year-over-year EPS growth was approximately 29%. Both the top-line beat and the EPS beat were clean. No one-time items distorting the headline numbers.
Gross profit was $1,293.3 million on a 54.9% gross margin. That margin compares to 56.5% in Q1 2025, a 160 basis point year-over-year contraction. The driver is commodity costs, aluminum for cans and sweeteners. Monster is managing it, but the headwind is real and present in the numbers.
Operating income was $730 million on a 31% operating margin. Q4 2025 operating margin was 25.5%, so the sequential improvement is substantial. Compared to Q1 2025 at 30.7%, operating margin is roughly flat year over year, which tells you Monster is absorbing the gross margin compression through below the gross line operating efficiency.
Net income was $569.5 million, net margin 24.2%, operating cash flow was $379 million, balance sheet $2,040 million in cash, zero debt, net cash of $2,040 million, current ratio 3.2. The 5-quarter revenue trend, $1.85 billion, 2.11, 2.2, 2.13, 2.35, shows the Q4 seasonal dip and a strong recovery to a new quarterly high.
EPS over those same 5 quarters, 45 cents, 50, 54, 46, and now 58 cents. Every single quarter has beaten consensus. The beat cadence is consistent and broad-based, reinforcing management credibility on guidance. On forward estimates, the street models Q2 2026 at $2.42 billion revenue and 62 cents EPS, full year 2026 at $9.5 billion, and 2027 at $10.8 billion. The bull case starts with international. The United States energy drink category is the base, but Asia-Pacific and Africa are the growth drivers. Markets like India, Japan, South Korea, and Sub-Saharan Africa are in early penetration stages. The energy drink category in those regions is where the U.S. was 20 years ago. Coca-Cola's global bottler network gives Monster distribution access that took Coke decades to build. No challenger brand can replicate that without spending billions and decades. Management has been explicit. International is the long-term growth engine, and it is still in the early chapters.
Pricing power is working simultaneously with volume growth. Revenue grew 26.9%, while unit volumes also grew, meaning price and volume both contributed positively. That is rare. Most consumer companies trading at these growth rates are buying revenue with price. Monster is generating it with both. The brand portfolio extension into Reign and Bang broadens demographic reach into fitness-oriented consumers and extends the total addressable market beyond core energy drink buyers.
The balance sheet is an underappreciated strategic asset. $2 billion in net cash and zero debt means Monster has full optionality, international expansion, acquisitions, or share buybacks without accessing capital markets. At $75.97, the stock sits near its 52-week low of $62.80, well below the 52-week high of $92.40. Forward PE of 27 times is below the historical range of 35 to 40 times during growth periods. The bull framing, world-class brand, fortress balance sheet, international runway, and a stock priced like the business is decelerating when the data says the opposite.
The bear case starts with gross margin, 54.9% in Q1 2026 versus 56.5% in Q1 2025, a 160 basis point contraction driven by aluminum and sweetener costs. If commodities stay elevated, gross margin pressure compounds into full-year earnings headwinds even with strong revenue.
Domestic saturation is a structural concern. The U.S. energy drink category is approaching maturity. Red Bull, Monster, and Celsius dominate shelf space in convenience stores. Incremental domestic volume share is difficult to capture without margin trade-offs, putting full burden on international execution to sustain growth.
Health and wellness trends represent a multi-year headwind for high-caffeine beverages as consumers skew toward functional and low-sugar options. Monster has responded with low-calorie SKUs, but the core product narrative faces this pressure regardless. Competition from prime and store brands intensifies the squeeze. 3 watch points for the next 2 to 3 quarters. First, international revenue as a share of total. The bull thesis is that Asia-Pacific and Africa drive the next leg of growth. Watch management's Q2 commentary for specific geographic acceleration data. If international share of revenue is not visibly growing, the primary catalyst is not materializing on schedule.
Second is gross margin. The commodity headwind drove 160 basis points of year-over-year contraction. If Q2 gross margin stabilizes above 55%, commodities are being managed. If the margin compresses further toward 53 to 52%, the earnings growth narrative gets complicated, even with strong revenue. Gross margin trajectory will be the single most debated data point in the next quarter.
Third is currency impact on international revenue. Monster is growing emerging market presence aggressively, but a strengthening dollar translates reported international revenue downward even when local currency growth is healthy. Management's Q2 commentary on constant currency versus reported currency will determine how much of the international growth story is genuine versus dollar headwind affected. Investors should watch for that disclosure specifically in the Q2 earnings call. The balance sheet deserves its own moment. $2.04 billion in cash, 0 debt, net cash of $2.04 billion, current ratio 3.2. In a consumer staples universe where most large companies carry meaningful leverage, PepsiCo at $52 billion in debt, Constellation Brands at high leverage ratios, Monster's net cash position is genuinely unusual. It is a function of the asset-light model. Coca-Cola owns the distribution infrastructure, so Monster does not need to capitalize trucks, bottling plants, or warehouses.
Free cash flow on a trailing 12-month basis is $1.58 billion. Price to free cash flow at 46.7 times is not cheap in absolute terms. But for a company growing revenue at 27% with no debt and an international runway barely started, bulls argue the FCF multiple is more defensible than it looks at first pass. The company does not pay a dividend, consistent with its growth reinvestment orientation. Buybacks are the primary return mechanism, and with $2 billion in net cash and the stock at 52-week lows, the conditions for accelerated repurchase activity are in place.
Options market heading into Q1 priced approximately a 5.2% move in either direction. Put-call ratio of 0.82 was close to neutral with a slight put lean. Call open interest concentrated at $80 and $85 strikes, reflecting modest institutional positioning for a recovery above current levels. The actual post-earnings move will determine whether that positioning paid off. No unusual pre-earnings options activity was detected, meaning the beat was not telegraphed by smart money positioning.
On insider activity, 2 sales under 10b5-1 programs by executive officers were reported in the past 90 days. Routine scheduled selling, not discretionary market signal transactions. Co-CEOs Rodney Sachs and Hilton Schlossberg retained substantial equity stakes built over more than 2 decades of compounding. The absence of open market buying at 52-week low prices is a mild data point worth noting. Management is not aggressively adding personal exposure, but the co-CEO ownership levels are already so substantial that additional purchases would be unusual regardless of price level. With $2 billion in net cash, The company-level buyback program is the more relevant capital allocation signal.
36 analysts cover Monster Beverage. Consensus is hold, 3 strong buys, 14 buys, 16 holds, 3 sells. Average price target is $88, implying 15.8% upside from $75.97. A hold rating at 15+% implied upside reflects street acknowledgement that the stock looks undervalued relative to intrinsic value, offset by uncertainty on gross margin and domestic saturation. The distribution of ratings skews constructive, with bulls slightly outnumbering bears.
This episode is for educational and entertainment purposes only. Nothing discussed constitutes financial advice or a recommendation to buy or sell any security. Charged alpha may hold positions in companies discussed. Always do your own research and consult a qualified financial professional before making any investment decisions. Past performance does not guarantee future results. Thank you for listening.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street